Hello again, everybody. Marty Mazzora here for the second time on Friday, the 3rd of March, 2023. This one's your economic update that we do each week. So I'm going to talk a little bit about what our index scored this week and then take you through a handful of the data points. And then I'm going to circle back Monday morning with the latest update of our equity market conditions index. We just do that one monthly. It's very important. We capture 12 data points that we think are very telling in terms of just overall general conditions, if you will, beyond just the price action in the equity markets. So without further ado, our index this week actually popped back up to the same degree that it dropped the week before. So we're back up to a minus 22, quite a ways from what we would deem a score that tells us that expansion or ongoing expansion odds are higher than odds for a recession in the relatively near future. We are firmly still in the recession camp right here. This week's inputs that I chose to illustrate for you. We'll start with auto sales. They actually came in better than expected, although they were off a bit from the previous month. So again, pretty decent on a relative basis relative to what we've seen since COVID. Historically, not fantastic, but again, better than expected, although not quite as robust as the prior month. Mortgage purchase applications continue to more or less fall off a cliff. We are at mid-90s lows, and they continue to decline, which of course makes sense when we're talking 7% mortgage rates currently. Initial jobless claims, on the other hand, continue to decline, down to 190,000, and even continuing claims dropped a little bit as well. Let me zoom out so I can help you put that into perspective. So we are at historic lows, big time. I mean, you can't really exaggerate how low that is. And hence some of the commentary, I know we've talked about this a lot of late, that, hey, how can you have a recession when the jobs data looks so good? Well, it's almost like, how can you not? Because when this thing turns, particularly off of low levels, it tends to turn right into recession. So unlike some pundits and some policymakers or officials might have you believe, the charts suggest that if and when unemployment does or jobless claims do begin to spike, recession could be in the very short-term offing. So again, it is by itself, it's unambiguously good, but it does not mean that it's a long ways from recession right here. The ISM Purchasing Managers Indexes came out this week, earlier in the week for manufacturing, this morning for services. Slight uptick, still very firmly in recession territory in the manufacturing space. And this one caused some consternation for the market earlier in the week when it came out for the equity market because prices paid component really went up. Today, services came out. It was just a tick below the previous month, although better than expectations. And the prices paid element actually ticked down a little bit. Still elevated, still high. I was reading through the report, in particular the commentary, which I always think is interesting. Let me share a little bit of that with you. From the accommodation food services, sales activity is generally strong despite economic headwinds. From construction, activity is steady. Costs continue to escalate, eliminating any profit we had hoped for in the first and second quarters. Education services, there is some slight improvement in availability and delivery turns. Finance and insurance, upward pricing pressures have eased slightly but are still elevated. From healthcare and social assistance, inflation, though somewhat eased from the peaks of the past 6 months, continue to drive higher pricing demands from suppliers. Hospital volumes are improving but have not returned to pre-pandemic levels in all cases. From the information sector, the current dynamics in marketplace are such that it is getting harder to reduce costs. Most industries are being pinched by inflation and more expensive labor markets. Before, cost reduction was the goal. It's now cost avoidance. That said, since we're not able to reduce costs to maintain margins, we have to reduce the employee base more aggressively to achieve markets Interesting. From management of companies and support services, seeing a slow decline in activity, but not a collapse like in 2009. From mining, generally flat activity level. From professional, scientific, and technical services, starting the new business cycle with a noticeable uptick in demand. That's good. From the retail trade, continual effort to right-size inventory to match lower sales forecasts for the coming year. So there is both a disinflationary and a recessionary signal from that last statement there. From utilities, the electric utility industry has seen some improvement on lead times and availability in some categories, but there are still issues with conductors, connectors, rubber molded items, and transformers, so still having some supply chain issues in the utility space. Lastly, from wholesale trade, business activity has improved slightly compared to last month. Supplier deliveries are faster and fill rates from manufacturers seem to be stabilizing. Customers now are very cost conscious and looking for lower priced product options. So yes, inflation's still there. Clearly, it's still a huge headwind. But you're seeing, like in that last statement, customers are not taking it so well anymore. So they're beginning to push on them at the margin. So folks, mixed signals for sure. But what we have is we have a mix of inflationary pressure and recessionary trends beginning to show up. A worst of both worlds scenario when you look at the task the Fed has in front of it. Now, as I talk to you, we addressed the stock market earlier today. We have got just a rip-roaring rally. The S&P is up almost 1.5%. The NASDAQ is up nearly 2%. So, folks, I'm here to tell you that is very inconsistent with the on-the-ground reality in either direction. If you think we're in expansion mode, then you better be ready for the Fed to expand its policies tighter, right? If you think we're in recession mode, then you better be ready for company earnings to drop below where stocks are currently discounting them, right? So what's going on with the market? Well, I've talked about it. I talked about it earlier today. We're spending a lot of time, energy, and resources understanding what's going on under the surface. And this is not the retail trader coming in and buying GameStop, right? This is big-time money, hedge funds, I suspect, institutional type money, coming in and making hay, actually selling options, selling premium into this phenomenon, which is this 0 day to expiration. And then you have dealers really willing to accommodate that. You're going to suck in a lot of people who are starting to see this happen. That does lend to these big ups and downs and these big swings intraday. Now, as I said to you earlier, the folks who we pay for their insights pegged 4,050 as the top end of the range, 3,950 is the bottom end of the range. Right now we're at 4,038. And so we're pushing the top end of that range. It'll be interesting to see if we don't just get pinned right up to the top end of that by the close, or if we get sucked down to around 4,000. But this is the very range that they said the optionings position was going to dictate. So, and I carried that a little further on the previous analysis. So if you didn't watch the earlier video, go ahead and go back to that one, and I'll keep moving here on the economic update. So durable goods orders on the headline dropped notably, but the core hung in there pretty well. Ex-transportation was up enough on a month-over-month basis. Consumer confidence is interesting. You've got the University of Michigan smaller survey, I think fewer questions, picking up nicely, still at really low levels. You got the conference boards that's showing consumers are feeling a bit more pessimistic than they did the month previous. Break-evens, we look at inflation or CPI swap rates to get a feel for what the market is discounting or compensating for with regard to inflation. So you can see on the tenors that we look at, 2, 5, and 10-year, we've seen quite the pop here after we had a downward trend. So the market is anticipating higher inflation going forward. The Baltic Dry Index is looking very interesting to me because we fell off a cliff, and now we've had 2 weeks straight with just an absolute ramp higher. That's actually bullish particularly on the global scene. So this is, bulk shipments across the world's oceans. Speaks largely to activity going on in China. And I've looked at some pessimistic views about the reopening. We're optimistic about it because the political incentives really demand quite a bit of stimulus to go into the Chinese economy. Actually, from what I gather, the activity so far has actually surprised to the upside the Chinese officials, and they are worried about debt bubbles and property bubbles and this sort of thing. So there's some speculation that maybe they'll dial back the stimulus a little bit here. But I think at the end of the day, they are going to kill themselves to hit their 5.5% GDP target for this year. I get the skepticism. I'm open to it. We're exploring it, because we did just recently add to emerging markets exposure just this week. But we also did some shuffling into more defensive exposure within the U.S. So we're still sticking with our recession thesis, but we do want to, over time, move more and more into the positions that we think make really, really good sense when the worst of this bear market is over. So anyway, so evidence from the Baltic Dry Index that global activity is picking up, and we think that probably has something to do with China. But overall, as it relates to the U.S. economy, little better look to it week over week with some of the data, almost even better based on a couple other things that we saw, beginning to generate. We think the market is really getting out over its skis right here relative to both inflation and the potential for recession. I'll say it one more time. I think I've said it a couple times lately. The market's discounting rate cuts late in the year. I think it may be right, but if it actually gets them, the economy is going to be in the kind of shape that is not going to be conducive to buying stocks. So it's interesting. The market is, seems to want to rally on any soft Fed rhetoric. But if they think that cutting rates late this year is going to be a good thing, but before we get there, we're going to have some economic dynamics that are probably really going to hit corporate bottom lines, and that's probably negative for the stock market. So probably, or probabilities is the operative word there. We're not wedded to the bull or the bear case. We're just doing the work, looking at general conditions and telling you what we think. Clients, it helps you understand what we're doing and or not doing within portfolios. We think we're probably going to have an opportunity to add risk or add more equity exposure, if you will, at lower levels, but that's not as important as doing it when conditions suggest it's a good time. So conditions could rise to these levels, and we could say, hey, we can unhedge or we can lower our hedges because here's what general conditions look like, and we can get more active in some of our best ideas that we think are the right ideas for the next, say, 5-10 years. I'll leave it there. Folks, thank you once again for watching and listening. Next up should be Monday morning with the latest in our equity market conditions index. Have a wonderful weekend. Bye-bye.